Hello, my name is Matthew Copley, and this video is going to be about how to set up the right risk tolerance in your investment portfolio and retirement portfolio. And this is really geared towards people that are getting ready to retire or maybe just retired. It's important to think about all of the money that you have saved for retirement as green and red money. And one of the things that you want to do that's really important is to understand not just the assets that you have in retirement, but also the total income that you're collecting. For example, your Social Security income or maybe a pension that you're going to get isn't really an asset that you have a lump sum that you can get access to. It may just be a monthly income. And it's important to think about what that income is over your retirement. And for example, if I have a couple and each one of them are going to get $1,500 each out of Social Security, that's $3,000 a month times 12 months times 20 years in retirement, we're talking about $720,000 in income. But when you're talking about Social Security or even some of the state and government pensions, there may be what's called a cost of living adjustment, called a COLA. And it usually goes up based on the consumer price index. And maybe it goes up at 2% a year or 3% a year based on the current low rates. But at the end of the day, you got to think about what that adjustment equates to over a 20-year period of time. So $720,000 in Social Security income might actually be $1 million in Social Security income over those 20 years. And so I like to classify all of the money that we're going to receive in retirement as either green money or red money. And what green money is money that we know is going to be there. Money from Social Security, money from a pension, money that you have in an FDIC insured bank account, money that you have in a fixed annuity that's paying an income rider, money that's insured, money that is that you know is going to be there for you. So that's green money. And then the other type of money that we like to take a look at is what we call red money. This is money that's in investments like stocks and bonds and mutual funds and ETFs, money that's subject to risk, and specifically market risk, but there's other kinds of risks. You know, we talk about bonds and they may not have as much market risk as a stock does, but bonds are subject to interest rate risk. And it's really important to understand what the potential risk is. We can run a Morningstar analysis and take a look at the bonds that you have, and we look at what's called duration risk. Right? How much are your bonds going to lose in value if interest rates go up 1%? And so we can take a look at that. And so we want to look at all these different risks, market risk and interest rate risk and currency risk and inflation risk and even lost opportunity risk, right? This is a risk. Sometimes people put all their money in the bank and they get a real low return because they're worried about market risk, but what they've taken on now is inflation risk and lost opportunity risk because they could have been making a lot more money on that money had it not been sitting in the bank. And of course, they may not be keeping up with inflation if inflation's running at 3% and they're earning 1%. So we want to look at all these different risks, and we want to think about money that's going to be there, that we know the income's coming in, green money, and then we want to think about our red money, and then we have to ask ourselves, what's the right balance for us? Someone that may have a large pension or large Social Security checks, they can afford to have more of their investment money in red money because they already have income coming in to pay the bills, and they can weather the ups and downs of the stock market a lot better than someone who doesn't have those pensions to fall back on. And so if someone comes to me and they've got this big $1 million 401k and they don't have a pension, it may be a good idea to shift some of that red money that's in the 401k over to green money. And you can do that by putting it in something like a fixed index annuity with an income rider, so we know that the principal is safe and that the income's going to come in. And then you can reposition the rest of the investments, maybe in something that has a little bit lower risk than the overall S&P market averages. Maybe we can put it in high quality blue chip stocks with a high dividend yield. Maybe they won't be as subject to as much volatility as the overall market index. And maybe we can generate a dividend yield that's double what you could potentially generate from the S&P 500 as a whole by choosing those high dividend type stocks. And so this is something to think about when you're thinking about green and red money in retirement. We do a risk tolerance analysis and we help our clients determine what the right risk is for them based on how they feel about the markets. And it's important that you kind of remove the emotions from the equation. Sometimes people think about who's president or this or that or the political stuff, and they make emotional decisions based on these things. We don't want to do that. We want to let the math make the decisions. We want to do fundamental analysis. We want to separate everything between green and red money, and we want to know we have a plan that kind of looks at all the different risks that are out there and is structured to protect ourselves, get us the most income, pay the least amount of taxes in retirement, and have the right balance so we're not going to make those emotional bad decisions which can happen with investments. So I hope that's a help. Thank you for watching. If you want to visit our local website, it's financialplannersandiego.com.